Trading isn't about chasing random signals. It's about understanding where big players put their money. Supply and demand zones are the footprints of institutions, hedge funds, and smart money. These zones explain why price bounces at certain levels and collapses at others. Think of the market like a battlefield. Buyers and sellers fight for dominance, and supply-demand levels are the front lines. Most traders ignore these hidden levels and rely on indicators that lag, but professionals look at raw price action. In this video, you'll learn exactly how supply and demand trading works, why it beats traditional methods, and how you can apply it step by step. If you've ever wondered why your trades stop out just before the big move, this strategy will open your eyes. So stay with me till the end, because this could change how you look at the charts forever. And before we dive in, don't forget to subscribe to The Trader's Mindset, where we bring you practical strategies to trade like a pro. At its core, the market is no different than a local bazaar. When demand for mangoes skyrockets in summer, prices rise. When supply floods the market, prices drop. The stock and forex markets follow the same law of economics. Demand zones are where buyers wait to load positions, while supply zones are where sellers are ready to dump. Unlike indicators that follow the price, supply and demand levels predict where price is most likely to react. Imagine spotting these areas before everyone else you know, where reversals are possible and where to avoid chasing trends. This is the edge professional traders have, and it's available to you once you start reading charts with this mindset. As legendary investor Warren Buffett once said, the stock market is a device for transferring money from the impatient to the patient. Supply and demand trading teaches you patience and timing, the two elements most traders ignore. Most retail traders rely on indicators like RSI, Massachusetts CD, or moving averages, hoping these tools will reveal the future. But here's the truth: indicators lag. By the time your MACD crosses, institutions have already moved. Think of it like checking yesterday's weather forecast. You can't carry an umbrella today based on yesterday's rain. Supply and demand zones, however, show you where orders are stacked right now. When banks want to buy millions worth of currency, they don't press the button once. They build positions at zones over time. If you can spot these footprints, you stop reacting to the past and start anticipating the future. This is why 90% of traders lose. They chase signals instead of understanding the mechanics behind price moves. By learning supply-demand trading, you move from being part of the crowd to trading alongside the smart money. So how do you actually spot a supply or demand zone on your chart? It starts with looking for strong, impulsive moves. If price consolidates for a while and then rockets upward, that base is a demand zone. It means buyers were strong enough to launch a rally. If price stalls and then drops like a stone, that base is a supply zone. Sellers overwhelmed the market. Mark these areas with rectangles on your chart. The next time price returns, watch closely. If demand is still present, price will bounce again. If supply is active, price will reject. A simple example: EUR/USD rallies from 1.0800 to 1.1000 after forming a base. That base at 1.0800 becomes a demand zone. When price comes back, you already know buyers are waiting there. This predictive power is what separates disciplined traders from gamblers. Why do these zones work so reliably? Because of human behavior and institutional mechanics. When large players enter a position, they can't buy or sell all at once. They split orders across price levels. This creates clusters of unfinished business, which act like magnets for price. Retail traders, meanwhile, tend to panic sell into demand zones or FOMO buy into supply zones, handing liquidity to the professionals. As Mark Douglas, author of Trading in the Zone, said, "The market doesn't care about you. It only reflects the collective behavior of its participants." By aligning with supply-demand psychology, you stop being the liquidity provider and start riding the waves created by institutional traders. Understanding the psychology of these zones makes you calm, patient, and selective qualities that are priceless in trading. One of the biggest mistakes traders make is assuming every bounce is a valid supply or demand zone. The reality? Markets often create fake zones to trap emotional traders. Professional traders, especially institutions, know how retail traders think, so they manipulate charts by creating small reversals that look like demand zones but aren't. For example, if price briefly bounces at a level with low volume and weak rejection, it's often a trap. Real demand zones come with strong rejection, high momentum, and visible institutional footprints. To separate real zones from fake ones, compare reaction strength. Did the market leave that level aggressively? Did it break a previous structure? If not, it's likely noise. Imagine a fisherman tossing back small bait to lure bigger fish. That's exactly how smart money plays. Your job is to recognize the difference and avoid becoming the bait. Filtering zones this way will instantly reduce false trades and improve your accuracy. Supply and demand zones alone are powerful, but when combined with price action, they become unstoppable. Think of supply and demand as the map and price action as the compass. For instance, if price is approaching a strong demand zone, instead of jumping in blindly, wait for confirmation like a bullish engulfing candle, pin bar, or higher low formation. These signals show buyers are stepping in with conviction. On the flip side, if price hits a supply zone, look for bearish confirmation before shorting. This way, you're not guessing, you're following market psychology. A great example is the 2020 gold rally. Demand zones aligned perfectly with bullish price action, creating massive rallies. Most traders lost money because they didn't wait for confirmation. They assumed zones alone would hold. Remember, the market speaks a language, and candlestick patterns are its words. When zones and price action agree, that's when probability is on your side. Trading then shifts from risky gambling to strategic execution. Here's where most beginners go wrong. They look at just one time frame and expect magic. The truth is, supply and demand trading shines brightest when used across multiple time frames. For example, you might spot a strong demand zone on the daily chart, but within it, the 1 hour or 15-minute chart reveals precise entry points with much smaller risk. This is called top-down analysis. Professionals always start big, then zoom in. Think of it like planning a road trip. The daily chart is your map, but the 15-minute chart is your GPS that guides the turns. If you ignore the bigger picture, you'll get lost in noise. By stacking zones across time frames, you filter out weak trades and find the ones that align with both long-term and short-term momentum. This is exactly how hedge funds scale into positions they're not guessing, they're aligning probabilities. By practicing multi-timeframe analysis, your accuracy will multiply, your risk will shrink, and your confidence will soar. Even with perfect supply and demand zones, without risk management, you're gambling, not trading. Every professional trader knows, protect capital first, profits come second. The key is simple place stop losses just outside the zone, not inside. Why? Because markets often retest zones before reversing, and if your stop is too tight, you'll be taken out. At the same time, don't make your stops so wide that they risk your entire account. Aim for risk to reward ratios of at least 1 to 3. For example, if you risk $100, the potential reward should be $300. This keeps you profitable even if half your trades fail. Imagine trading like a casino. They don't win every bet, but their edge over time makes them rich. Your edge is supply and demand, but risk management is the house rule. With discipline, you'll never blow up your account, and every trade will become a calculated decision, not an emotional reaction. At its core, supply and demand is not just a strategy, it's a mindset. The best traders don't chase trades. They wait like hunters, patient and focused. They know the market is a battlefield of emotions, where fear and greed destroy the unprepared. By understanding zones, filtering fakes, combining price action, analyzing multiple time frames, and managing risk, you're already ahead of 90% of traders. But the final step is mastering yourself. Like Mark Douglas once said, trading is not about being right. It's about managing risk. If you can control your impulses, trust your zones, and stick to the rules, consistency will follow. Remember, the market doesn't reward the smartest, it rewards the most disciplined. If you want to transform your trading from random guesses to a professional system, now is the time to act. Subscribe to The Trader's Mindset for more strategies, psychological insights, and advanced breakdowns to sharpen your edge and grow your trading journey.